All right, welcome back to the channel. Today we're going to be checking out Walt Disney Company, ticker symbol DIS. Getting into the 5-year chart, we can see, it's it's down over the last 5 years, down about 22.59%. From the highs, the recent highs, we're down about 55.78%. And Disney has been getting just crushed lately. I think, Bob Iger, the CEO, say something about selling a bunch of assets, and everybody's like, I don't know, it's in the news a lot lately. So I wanted to do a quick overview of it, quick dig into it, because I'm kind of interested in this one. I just don't know how interested and at what price. So let's go ahead and go over to the investor relations page. All right, here we have the second quarter 2023 earnings presentation. Let's see what we can find through here. All right, so we have revenue is up, income from continued operations before income tax is up, diluted EPS from continued operations is up, diluted EPS excluding certain items is down. What does this tell us? I don't know. Total segment operating income is down, so I'm not sure what they are including or excluding from these. I would take all of this with a grain of salt because something seems a little fishy. Diluted EPS up, operating income down. I don't know, maybe I'm crazy. All right, and here they're going off of, looks like just some new releases that they have, some results over the last year. 7 Peabody Awards, yay. Season 3 of The Mandalorian, okay, cool. NBA playoffs, neat, I guess. Media entertainment distribution results, interesting. So linear network 7.1, direct to consumer 4.9, so 1.9, interesting. And I just realized that it's actually a decline, Q2 2023 versus Q2 2022. So basically decline in linear, increase in direct to consumer, which I like that, increase in CSLO, content sales licensing. So yeah, that's pretty good. All right, and then we have DTC quarterly operating income in billions, and they are still operating at a loss. So direct to consumer, still a loss, still burning cash. Let's see, core subscribers for Disney Plus are relatively flat from the previous quarter, but up significantly from the previous year. So Disney Plus Hotstar, I don't even know what that is. Okay, cool. But those have decreased on a quarterly basis, quarter over quarter, increased on a year over year basis. So we see a increase in ARPU for Disney Plus Core, and it looks like we're seeing a decrease in Disney Plus Hotstar. Then we get into Hulu subscribers, still growing slowly. Q1 2023 and Q2 2023, we see quarter over quarter increase of about 0.2 million. It looks like pretty decent increase over 45.6 over last year. ESPN Plus subscribers is still growing as well. So that's the good thing about the platforms, is that they at least have subscriber growth. And it looks like they're having, no, this is actually ARPU decreased by 73 cents. TV Plus ARPU increased by 442. So Hulu Live TV and plus SVOD is increasing, but I'd be very interested to see what the margins are on that, because typically TV packages are pretty low margin. If I remember correctly, you're paying broadcasters a lot for that content. So maybe we can see that later on. ESPN Plus ARPU increased 11 cents, so that's good. So from their streaming services, seems like they've had pretty decent subscriber growth, and they're going to continue to grow. They kind of have a pretty nice package between Disney Plus, Hulu, and ESPN Plus. I personally have it, so there's that. Obviously, that does not make it a good investment. So we have revenues from parks. Looks to be increasing over the last year. Pretty decent amounts. Let's see, consumer products are decreasing, international parks increasing, domestic increasing. Operating income is increasing, but not anywhere near the point that it was previously, I believe. We'll look at that later in the financials. So operating income is kind of the same as revenue on a per basis. It's increasing as well, increasing domestic parks, increasing year over year on international parks. Decreased a little bit on consumer products. And then we have all the theatrical releases coming up. I don't know. Indiana Jones, that might be fun. Yay. I'm not huge into movies, so yeah, it is what it is. Let's see, Disney Plus and Hulu releases coming up. So, all right. I still probably spend most of my time on Netflix, honestly. That's just kind of how it goes. At least for my household, it's mostly Netflix. But I could totally see if you have kids, Disney Plus, reigning supreme in the house. All right, and then here we just get into some financial information. We'll go over that later on. I don't see any forward-looking guidance, at least in the investor presentation for this quarter. We'll skip over to the investor release and see, or the earnings report, and see if there's any type of guidance there going forward. I have a feeling I'm probably gonna have to listen to a lot more earnings calls on this one. Let's see. All right, so I breezed through this and I did not see anything regarding forward-looking guidance, expectations, anything like that. So kind of interesting. I don't know, maybe I just missed it in here. I'll search through here as well. Yeah, no dice. So thanks a lot for that, Disney. The company without a plan, maybe? I don't know. It's probably in their earnings calls and whatnot. I need to dig into that more, but let's go ahead and just go over to the financials, and we'll see how demolished this thing has gotten over the last several years going through COVID. Just from a bottom line basis, we can see that they have been crushed in about 2019 to 2020. They just got destroyed. Obviously, a lot of parks business pulled back during that time through the COVID lockdowns, but then they also shifted heavily to their streaming services, increased a lot of CapEx spend for those services, and it just ate away at their bottom line income pretty drastically. So the question now is that, are they going to be able to fix that going forward? When is that going to kind of like return, or will it return eventually? Let's see if we can check out revenue here as well. All right, so I added revenue to this, and we can see the slight pullback, but a total annihilation in margins going into 2020, and then we have an increase in revenue over 2022 and 2023. So, yeah, man, this is weird, because it's really about, like, they pivoted the business to heavy streaming in 2019, 2020. Is that going to have equal or better margins once all of this normalizes? That's a tough one. We can see previously from bottom line yields, they've kind of moderated between 5 to 7%, something like that, and then crashed down during the whole business change and the COVID crash. Let's go over to the income statement, and we can see steady increase in operating expenses and SG&A, and bottom line numbers fairly stable, and then just fell off a cliff kind of in 2019. Looks like they probably made that pivot towards streaming, and then we had the 2020 pullback, and yeah, that was lovely. Have a little bit of a dilution here in 2019, it looks like. They were buying back shares before that, and then, yeah, they stopped because they're dumping basically everything into the streaming services, it seems like. EPS steady went up. Was going up decently, and then obviously crashed. So man, this is interesting, because they were doing decent for a while. They were buying back shares, decreasing their float, while their net income stayed pretty much the same, if not growing a little bit. And then they made this pivot, and basically the entire, entire financial structure of the company like just went a totally different direction. Balance sheet, let's see what type of debt they're working with right now. Yeah, so we have it took a little bit to update. So yeah, what, 10 billion in cash, and they've got currently about 45 billion in long-term debts. So yeah, 2019 started taking up on a lot more debt through 2020 and starting to pay that down now. Looks like the debt at the peak was about 55 billion. Now it's around 45. So 10 billion pay down in several years, which is pretty interesting. We have goodwill and intangible assets. So that increased in 2019 as well. Must have done an acquisition or something. I gotta be missing something totally obvious. But maybe there was an acquisition. I think there was an acquisition involved when they pivoted to streaming. Oh, so they acquired 21st Century Fox. Okay, in 2019. Lovely. Price in US was 71 billion. That's interesting. Okay. Well, that's where that came from. Free cash flow statement, let's go through there. And operating cash flow, we can see, has been declining over the last couple of years as well. Basically, 2019, man, just started going downhill from there. SBC isn't that bad. Depreciation and amortization has jumped up a bit, and their capex and their depreciation and amortization probably will increase as they go heavier and heavier towards streaming, assuming they do go heavier and heavier towards streaming, because it's going to be a lot to build out and maintain, and then your capex cycle is going to be about 5 to 7 years on that equipment, depending on how long they can get their infrastructure to last. All right, we got free cash flow. Let's see. Same thing. It's like nice, pretty steady until 2019, and then just chop the heck up. Most of their cash flow looks like it's going towards debt repayments. Dividends. Do we have dividends? I think we have dividends, do we? I don't know. We'll see. Taking some time to load. 2019. No. So this is off. This is in 2019. So they cut their dividend. I would assume they completely cut their dividend. Go ahead and verify that. But it looks like they cut their dividend and cut their buybacks. Oh, God. Oh, Lord. So just not a lot looks good from this after 2019. Ooh. Oh, man. I don't know. Let's look at their leverage ratios. Yeah, so you can see dividends paid. It looks like it stopped in 2020-ish. I wonder if I have bad data here. Nope, I don't have bad data. Looks like the last declaration and the last payment date was in 2020, so they definitely slashed that dividend. All right, so we have operating cash flow per share and dividend ratio. Oh my Lord, look at the operating cash flow crash after that acquisition. Just, oh my God, it's bad. Not good. Interest expense ratio is 23% interest they're paying compared to their operating cash flow. Their cash flow coverage ratio is pretty crap at 12%. So about what that essentially means is that their operating cash flow equals about 12% of their overall debt on a yearly basis. More of the same thing, more of the same theme. It looks like crap after 2018, 2019. It looks like they just burnt everything to the ground as far as their financials go, and how they were essentially allocating capital and being able to return capital to shareholders. It really seems like that acquisition, along with the pivot to streaming and increasing those expenses, along with COVID hitting and taking people away from parks, they had the trifecta. And it just looks pretty dang gnarly. So, okay, let's get into the evaluation then. I don't know. I don't know what we're going to do here, but let's get into it. Now we have to ignore that dividend yield because that is fake. So we're going to do 12.5% target CAGR with 15 or 2.5% margin of safety, which is a 15% total target CAGR. And we can see that it's typically traded in that 5 to 7% range, but we might have a little bit of multiple expansion, assuming the market is basically pricing them based off of text streaming services. Yeah, so obviously margins just got destroyed. I mean, gross, net, all of them, just all of their margins got crushed. Revenue is still on a decent pace. If they can do this right and, streamline their streaming services and increase their margins on that side, while having all of the, IP for all the entertainment that they have, especially on the Disney side, they could recover. It's just like, it's not looking good the last couple of years. It's definitely feels like it's a turnaround play. But the good thing is that they have some incredible IP and some incredible entertainment to help them get there, right? They're just historical library should be a huge advantage to them. And they should be able to kind of tweak things if they can't get streaming profitable and they're just like, it's not worth it, then maybe they focus more on licensing and, just licensing that content out to other streaming providers that are going to be much more efficient. And then the profit margins off that would be much, much better. But man, oh God. So I think we can use a pretty, I don't know, maybe like a 4 to 6%. Something like that, 4 to 6% bottom line yield. Yeah, let's get some numbers plugged in here. All right, I had to take some time and wrap my hand around how I wanted to do this. So essentially we have a average yield spread in the very bullish case of 3, a very bearish case of 6. But more importantly, I kind of wanted to get my head around how I was going to forecast out potentially a recovery. And in this scenario, basically what I did was I had their bottom line numbers recovering after the 5-year period. So if we remove revenue here, all right, so essentially I've got their bottom line income recovering to 2018 levels in 4 or 5 years. And that's for the base case. So we can see the base case is 14.8, 12.5, 9.8, which is very similar to their previous highs of 14.8, 12.5, 9.8. So, 14.8, 12.5, 9.8. This is, and then because it's a streaming, like if they did this and it was driven by the streaming platform, I think we see maybe some decent multiples given from the market on this. So that's why I chose the yield spread between 3, or the yield variation at the 5-year period between 3.07 and 6.03. For the dilution, we have 0.07, so basically flat dilution to 1.89. Over the last couple of years, we can see that the dilution has been pretty muted and tamed, other than that acquisition and then additional dilution in 2020. So I feel like I'm being pretty, I don't know, I'm giving the benefit of the doubt in a lot of these different areas, but I don't know, I'm just not sold. I could easily, just because of how uncertain I am with this, I could easily bump this up to like a 15% and say, I want a 15% target CAGR, because I am not certain in the turnaround, right? I'd have to have a lot more confidence in the company and the business to be able to probably justify having a lower margin of safety, or just being okay with a 12.5. So right now my margin of safety would probably be 5%. I don't know. I'm just not comfortable with it. So we'll do 15% target KR just for, I don't know, kicks. But I think I would probably kick this one up to probably a 5% margin of safety where I am right now on it. So in this theoretical scenario, you can kind of see the revenue growth numbers over here under the different scenarios. The very bearish isn't even recovering to previous highs. The base case is basically recovering to previous highs in the 5th year. The bullish scenario is surpassing, the very bullish scenario is far surpassing the previous highs. After 5 years, EBIT would be about 19.8 billion. Net income 16.8, free cash flow 13. So for those, and if the recovery was faster and they were able to pull some levers and really increase that bottom line cash flow quicker, which is totally possible, I think there's different things that they could tackle to do that. You could definitely see, I think, one of these more bullish or very bullish scenarios taking place. But right now, with how I have this, we have bottom line growth between 13.28 to 25.46%. However, I did manually adjust it in order to project out the scenarios that I wanted to get. So, and basically the manual adjustment is saying that they're going to be able to recover these margins much quicker than, what they've been doing lately. So basically we see revenue has been growing, and this would be a story of the business being able to recover those bottom line margins and increase their cash flow to previous highs and exceed those in kind of the bullish and the very bullish case over the next 5-year period. All right, so with that being said, 15% KGAR for the very bearish scenario here. We can see it's buy price of about 42. The bearish scenario, buy price about 60. Base case, buy price about 80, and we're almost there right now. Bullish case is 109 buy price. Very bullish case is 150 buy price. 5-year targets for the very bearish, right? That assumes that we don't even recover to previous highs. The market gives it a pretty low multiple. I think that'd be about a 16 or 17 PE or price to cash flow or whatever. That would be a 5-year target of $86, which is a little bit lower than where we're at right now. The bearish case would be 118 after 5 years. The base case would be 161 after 5 years. And I think the base case, I'm leaning towards that's what's realistic. I think that's a pretty realistic expectation for me to have with this one and just my really lack of knowledge in this space. Bullish would be 219, very bullish would be 302. So yeah, I'm super hesitant on this one. But I can see scenarios playing out where they recover their margins. They either increase their efficiency in their streaming platforms, or they up their licensing and they focus on higher margin aspects of the business, and they're able to recover those. And it could this could be one of those where it happens quicker than you think, and before you know it, they're back up to previous highs when it comes to their kind of cash flow, net income, and earnings before tax. So yeah, this is an interesting one. I mean, just their video library and their IP alone is okay, they have that, they should be able to monetize it well. Come on, even crap management should be able to eventually figure this out. But I don't know. We'll see how it plays out. It is getting to very interesting levels. We're closing in on basically 5-year lows. I think, what was the 5-year low? Well, maybe 85 was the bottom of COVID. And I think it got there. It has almost tested that. So, it's looking interesting just from, being beaten down so much. But we got to see some of these better scenarios play out right now for it to make sense for me in my case. And they totally could. I think I'm going to be a little bit more, I don't know. I'm just not sold on it. I could see myself getting into it. I'm just not sold on it. So we'll see what happens. Hope you guys have had or are having a great weekend. And yeah, we'll see you in the next one. As always, this is not financial advice. This is just my musings and looking over another company. So do your own research, your own valuation, everything, and do not, buy or sell or do anything based off of a guy, on YouTube ever. Please don't do it. Just don't. Just don't.